pull this computer off.
Hi, everyone. Welcome to Crowd Forecast News, episode number 168 for January 29th, 2018. Today we will be discussing the 227th weekly report, which you should be seeing on your screen right now while I'm talking. But you can also go to TimingResearch.com and download the full report there if you haven't had a chance to yet. I have John Thomas here moderating for the first time, so I'm going to go ahead and turn it over to him.
Good morning, good afternoon, everyone. This is John Thomas from the Mad Hedge Fund Trader, and I've been given the great honor of hosting David Kosmitter's current Timing Research Crowd Forecast and News Report number 227. I have three esteemed traders and market experts with us today. We have Simon Klein of TradeSmartForex.com. We have Stephen Brooks of StephenBrooks.com. We have Michael Filguera of LogicalSignals.com, and of course, yours truly, John Thomas from the MadHedgeFundTrader.com. Why does everyone say hello and just give us 10 seconds or 20 seconds about what you do and why you do it? Let's start with Simon Klein, our foreign guest.
Oh, hi, everybody, and thanks for having me again, David. It's great to be on the show. Can you guys hear me okay?
Yes.
Yeah, I hear you fine. Sounds good.
Excellent. Okay, great. I'm working on two computers now because the sound wasn't working on this one. So I started TradeSmart, the website's TradeSmartForex.com, a number of years ago after training traders for many years offline. I decided about just under 3 years ago to go online and reach a wider audience and have an impact in people's lives in a positive way in the trading sense. So what TradeSmart Forex does is train people from beginning trader, but not necessarily, through the whole journey to become a master trader, from teaching people how to read the market professionally to how to run a trading business, and then working with people one-on-one to help develop their own personalized trading plan that's suitable and fitting to their own personality and lifestyle.
Okay, great. Stephen Brooks of StephenBrooks.com. What do you have to say for yourself, Mr. Brooks?
Well, thanks for having me today. Very exciting. I used to be a professional baseball player, and over the last 10 years, I've been a self-directed investor and an investing coach for the last 3 or 4 years or so. I specialize in taking someone that has zero investing experience, like doesn't even have an account, and showing them simple setups that are easily identifiable that they can follow. And why do I do this? Because I absolutely love it. I would do it for free.
So I have to tell you, you look like a professional baseball player. Can I ask what your batting average was?
In the minor leagues, it was 288. In college, it was closer to 350.
That sounds pretty good to me. Okay, Michael Filiguera, excuse me if I use the Italian pronunciation of your name, of LogicalSignals.com. How are you today?
I am doing well, thank you. I've been trading. I started my trading career in 1979 here on the Pacific Exchange on the options trading floor. I've traded here. I've traded in London on the London traded options market. I've traded in Amsterdam and I've traded in Germany before returning back here. Currently, I am switching it up a little bit in that I am going to be using my trade room to do coaching. And so we can do live coaching and I can get people in there and it's a one-on-one and hopefully help them almost in the same vein as Stephen's doing, but not quite. They're kind of coming in, but my belief has always been that there are a lot of blocks that traders run into that prevents them from either returning to being profitable and successful or getting over that block and actually turning their situation more positive. And so I've done a lot of work in that area and I'm going to be starting that.
Okay.
And also just providing commentary.
Great. And this is John Thomas, the Mad Hedge Fund Trader, who I I know many of you already know and love. We do long and short recommendations on stocks, bonds, commodities, foreign currencies, precious metals, energy, and real estate. Been at the game about 50 years, and I'm looking forward to the next 50 years. And we averaged a 59% return for our investors last year. Okay, let me dive right into things. Question number one for the day. Which direction do you think the S&P 500 index will move in this coming week? Starting from now, going into the Friday close, how do you see it? I'll start with Simon.
Probably, well, I'm kind of neutral on it because we're after quite a big move up already, but trend still up all around. So potentially higher, I would say around 50%.
Okay, and Stephen, what do you think?
Well, this is kind of a funny question for me to answer, because every single time I think in the last 10 years that I've actually picked a direction, I've been dead wrong, which is probably the sign of actually being a trader. We are up, what, 6-7% in the S&P so far this year. Every single dip seems to be met with buyers, and I think that is no different than today. And even though I guess the futures are down about 8 handles right now, you have a very business-friendly speech that could potentially happen tomorrow night, and you have some very, very high-flying tech companies like the Googles and the Apples and the Amazons of the world reporting towards the second half of the week. So I think it's tough to bet against a positive week this week.
Okay. Well, if you're always wrong, you're worth your weight in gold. I'll just do the opposite.
Do it.
What Martin Biggs used to do. So it's what he used to tell me. Okay, Michael, how's the week looking to you?
I am actually saying higher. Pretty much in line with what Stephen had mentioned. We've got some larger companies reporting this week, Amazon being the biggest, and Amazon is following through exactly pretty much on the other show that David does, was commenting that Amazon reports at the end of the week along with Apple. I believe we've got, I was reported yet. So we got Tesla
Apple on Wednesday, don't we?
The same day as Amazon. It's on Friday.
Yeah, same time.
Yeah. So that could really, I think, just in anticipation. Apple, now they're questioning whether it's going to be good or not. But anyway, I believe higher, and I'm going to go with the 65%.
Okay. Question number two. We pretty much covered rate your confidence to question number one. How certain are you? I guess I have to put my 2 cents in here, and I'll say that I expect a sideways time correction in the markets to last over not only this week, the next couple of weeks, so that the market can work off some of the most extreme overbought conditions in history. 50% up or down small. I don't see any big moves from here one way or the other. Fantastic earnings are supporting us from collapsing. On the other hand, the extreme overbought conditions are capping us on the upside as we move into February, which is normally a reversal month for January. So yeah, I'll be about as neutral as I can here. Let's see. Simon, what major factors do you see affecting the market in the coming 5 days?
Well, I'm a purely technical trader after actually trading fundamental or trying to trade fundamentals for quite a number of years and not seeing much correlation between fundamentals and what was actually happening in the market. Because sometimes it was good news that came out, and the markets or the stock that I was looking at would go down, and sometimes good news would come out and the stock would go up. So I kind of moved back away from fundamentals into just reading the footprints of money, which are the charts. It's telling you exactly where money's going, money flow, and everything you can see from the charts. So looking at the charts alone, you can see that we've actually had quite an accelerated move up after already having a year of moving up and getting quite a steep ascent to the upside, which sometimes indicates this could be the end of the move to the upside. It's not ready yet because we're still uptrending on monthly, weekly, daily charts. And so the trend is your friend until the bend in the end. So, but we may be coming close to a top. If we get another, another surge to the upside, that may very well put in a top. Much like running a marathon and then doing the final 100-meter sprint. Can you run another marathon after that? That's the question.
I should point out here the results of David's survey among his own followers. 68.9% said the market would be higher this week. 31.1% think that it's going to be lower. That's a difference of 37.8%. And I think that's probably one of the most bullish readings, David, that you've ever got. Am I correct on that?
Yeah, it's near the top of the highest ever.
That is quite a divergence, and that alone can be taken as an indicator that we may be reaching some sort of short-term top. I would imagine that technical traders must be going crazy these days because we have been overbought for months now, and all we've done is gone from very overbought to extremely overbought. So Stephen, what's your read on that analysis? Am I out of my tree, or are you seeing the same things I am?
Yeah, well, again, I think the first question was, why do we think it's going up? And a lot of people talked about earnings. I mentioned that there's a big speech tomorrow night that could be bullish just based off of track record of those types of speeches with the current administration. But I think what's really interesting is obviously without all that, without earnings, if you didn't know any of that was happening and you just looked at the market on a given day for pretty much the last year or even since November of 2016, you would have seen very few days where the market closes towards the low end of its range for that day. You would have seen far more cases where maybe the market sells off at the beginning of the day or sells off overnight, only to find itself higher by the end of the day. So if you really just look at that, people are really just finding any opportunity to establish long positions. So forget all that other stuff, the earnings, the speech. People are really taking every single sell-off as an advantage to put more money to work.
And how long does that continues until it doesn't, basically? That's right.
Yeah, it continues until it doesn't. You get a little more risky the more parabolic a move gets because you have more people getting in so much further away from, let's say, a volume weighted average that some people believe is fair value, if you will. So the more upright you get in a move, the riskier it gets. But again, markets can stay irrational far longer than anyone has the stomach for.
And who said that? I've heard that before.
Everyone. I don't know who said that. Who did say that?
The answer, famous economist of the 1930s. Michael, tell me what's going on in this crazy market of ours.
I am basically a technical analyst as well, and I am astounded at how overbought. But what I believe is going on is that, particularly in the Dow, and the Dow is going to carry the other indexes along with it. But if we take a look at the Dow, go back to the turn of the 20th century to really find the beginnings of this now ending up being, at least 118-year bull market. And because of its length of time, estimate that this thing is not going to just go in a blow-off fashion. Because it's so long, that blow-off is going to just surprise most people. It has already surprised me. I had set targets for where I thought these markets would finish up. All those targets, particularly in the NASDAQ, have been blown out of the water. judgment call. But I believe that we're finishing. I believe very strongly that we're close to finishing. I think that what also continues to contribute to the market are the algorithms. It's a different type of trading that we're experiencing right now versus when we were running higher in 1987, for example, or even in the 90s, or coming up. Once firmly took over, an algorithm turned control, but overbought or oversold is, so they just continue to do the directive. And as long as
they just know that the last tick was up. That's their time frame, is the last tick, essentially.
Yes.
I think we're getting a repeat of 1999, which was the final year of the dot-com bubble top. In the last 6 months of the dot-com bubble, from October to March of 2000, NASDAQ went up 80%. And I think we are in one of those melt-up periods now. So, yeah, you can be long here. I mean, we're aggressively long right now, but we're long deep in the money call spreads, which also are profitable if the market goes sideways or drops a little bit. I think too many people were caught underinvested going into the beginning of this year, and they're all playing a catch-up game. And that can go on for a really long time. So, anyone else have any insights here they want to toss in? Okay, let's go on to the next question, which is, let's see. What do you think the major factor driving the markets is right now? And I'll go back to Simon for this answer.
Well, again, as I said before, I'm a technical trader, so what's driving the market is in an uptrend on the monthly, the weekly, the daily chart, and it's momentum, everything's moving up. So the trend is your friend until the bend in the end. The market will continue moving higher until the trend ends.
Okay, Stephen, any comments here?
Yeah, so again, the price action is showing that people are remaining bullish. They're looking for any opportunity, any single name to really establish some sort of a long position, put money to work. So I don't necessarily have a single factor. There's a couple things at play. You have some companies that are benefiting from sort of tax laws. You have some companies that are benefiting from the potential to repatriate money. You also have very strong earnings for the most part across the board. So if you don't have interest rates getting out of control and you don't have the Federal Reserve really tightening quickly, you don't really have a lot of cases that aren't bullish.
Okay. Michael, what are your thoughts here? Michael, you with us?
I think he's frozen.
Okay, then I'll go on with my response here. I think we're in an unprecedented market here. We've been going up for 9 years. We are now the second longest bull market in history. The longest one actually was, I actually remember the last longest one. That was 1947 to 62, 15 years under the Eisenhower administration, when everything was suddenly brought to a screaming halt by the Cuban Missile Crisis. I don't think North Korea will ever reach the significance of a Cuban Missile Crisis. In fact, I think the whole North Korean situation is just total noise. And anyone who stayed out of the market because of worries about North Korea has been punished severely. So I think we can continue to ignore North Korea. They have no targeting system for their missiles. All they can do is shoot them up in the air and watch them go boom. So I think even at this late stage, to be underinvested is dangerous. And you can also go with technology. The earnings are coming through much better than expected. What's happening is, the market is briefly becomes expensive, then a bunch of earnings come through and make it look moderate again. We've been basically trading between moderate and expensive for the last 2 years, and that's given us this parabolic market with no pullback. So I think the next recession is 2 years off at the earliest. That means we have 18 months to go in the bull market, since bull markets usually end 6 months before a recession, and that the final phase of a bull market is usually or often is the sharpest move up you get, that final blow off top. So if you miss this last part, your relative performance compared to the rest of the industry will suffer severely. Okay, let's see. Did we get Michael back?
We did.
Okay, Michael, you want to go ahead with your views here?
I'm very much in line with what you're saying, John, and I didn't really hear Stephen, but I think we're very much in line on what we see happening. I think that, short term, I agree with you. We get extremely expensive, and then we pull back a little bit, and we get some sellers that move in, but then earnings come out, and that takes it back. And I think that's what's going to continue to happen until at least we're out of this particular earnings season. I don't necessarily have the same longer-term view in expecting a recession in 2 years or a year and a half, whatever the number was that you gave. But I do agree with how it all unfolds and what happens. Again, we've got a nervous Fed. We have a new Fed chairman. So I think a lot of things can trigger this market, but it could be nothing but a pullback.
Yeah,
and in
I
which
think
case,
if the Fed raises out of the blue on Wednesday, that could be worth your 5% correction right there. Unlikely, but they have to be worried about asset price inflation.
That is creeping in. They're just not saying it, but they might be amongst themselves.
Yeah, no, I would totally go with that.
What does the Fed Fund futures have them at for a rate hike on Wednesday?
I haven't seen the futures contract, but I would bet it's under 20%.
Yeah, that would definitely scare the children.
Yeah, for sure. Okay, another question here. I'll start with Simon again. Simon, where are you broadcasting from? Because your connection's kind of coming in and out.
You can hear me okay?
Yeah, but it's iffy. Where are you based right now?
Because I'm on 2 computers at the moment at the same time. One's a laptop and desktop, because the sound wouldn't work on the desktop.
Well, that may be eating up your bandwidth.
Probably. Probably.
Yeah. So, Simon, what procedures do you use to monitor and evaluate your trading results and progress over time?
Trading log and trading journal. Now, again, to go into the details is kind of involved, but basically you want to keep track of every single trade you do and what strategy you're taking, time of day, what instrument you're trading, and then you want to also keep track of things like batting averages and win-loss size ratios. And once you have all that information, you can have an equity curve, then you can have a good understanding of your performance as a trader. For example, if you're in a sideways choppy market and you keep track of what percentage of the actual move you've got, and you're getting, say, 60, 70, 80% of the move, and then the market moves into a trending market, and then you're tracking that you're getting now only, say, 30% of the move, then you need to adjust the way you're managing your positions. Obviously, the market's now transitioned from sideways choppy to trending, and then you can hold positions for longer, and you can see that reflected in your performance. If you track what percentage of the actual move you got, that's one way of doing it. Another very important thing to track as a trader is yourself. I always say to my traders, you need to have a finger on the pulse of the market and also a finger on your own pulse. Yeah. So you need to know what's working for you as a trader when you go. Sometimes when you go through, bad patches in your trading, what gets you into that, and how do you get out of that, for example. That happens to everyone. And when you're trading in the zone, how did you get into that, and how long can you ride that? And again, there's a lot of psychological sort of factors that go into making of the master trader, so to say. So to make sure you've got your trading mindset in the right, built in the correct way. So these are things that you do with the trading log and trading journal on a continuing basis.
Okay, Stephen Brooks of TimingResearch.com. What procedures do you use to monitor and evaluate your trading results and progress over time?
That's a great question. So there's two things I'll say about that. The first is I look at my net lick value of my portfolio, because how much money is in there is ultimately the most important thing. And I don't have a trading journal. I don't really look at past trades. I don't really try to calculate anything. I don't try to look at any data. The more engaged you are with the market, the more you're paying attention, the more you're getting a feel for setups or strategies that are working or aren't working, the more you'll get an understanding of what is working for you, what's not working for you, why. So rather than me writing everything down, the more engaged I am with what I'm doing, the better understanding I have of how's it going. But ultimately, the net lick, the total value, is the most important thing.
All right. Michael, what have you got to say on the issue?
I do it daily because the bulk of my trading is day trading. So I have within there, I can look at account performance, and I can look at the individual accounts that I use, and also then the individual products that I'm trading. So it's done on a daily basis, and it's broken all the way down. And I can get readings on how long each trade was in, what the percentages are, loser, etc. So I do it every day.
Okay, and as for myself, John Thomas, I ran a hedge fund for 10 years. When I retired, I took my old hedge fund accounting software and applied it towards my newsletter and trade alert service. So we have a daily mark-to-market, just like any hedge fund does. We publish that every day. We post it on our website so people know exactly how we're doing, and also that the accounting is honest. With too many services out there, the losses tend to get lost in the shuffle. You only hear about the wins. So, you have to show both, because you have to know what's working and what isn't. Last week we had a long position in Apple. We stopped out of it. We took a loss, a 2% loss, and that's part of real trading. If you find a trade alert service that never loses money, run a mile, because then you know for sure it's fake. Okay, we have some more time here, so let's address more factors that may be affecting the market. At the end of last year, the big debate in the market was, is the tax cut in the market or isn't it? Here we are, 7% higher. How much of the market move is tax cut driven, and how much is related to other factors, and what are those other factors? Simon of TradeSmartForex.com, I'll start with you.
Again, it all comes down to, I'm a technical trader. I just look at the charts and I see what I need to see in the charts. No other factors really bear in those decisions. It's all about the supply-demand imbalance and what you can see in the charts, and where money's flowing. So nothing else is really that interesting to me.
So let me ask you this question. As a technical trader, let's say you got a hold of some information that convinced you that the Fed was going to start raising interest rates quickly. Would that change your market view, or would you wait for that change to be manifested in your charts first?
I just look at the charts and I'll see what I need to see in the charts.
Okay, well,
won't make any difference.
Okay, Stephen, how about you? Tax cuts, are they in or out of the market?
Well, they don't impact very much any of my decisions on a day-to-day. just looking at it, hey, you're up 7% before the first month of the year is out. That's a pretty big move. It can't be hurting it. So they're definitely helping it. But again, you have a lot. I mean, you have very strong earnings across the board. There's a lot going on that's just besides taxes, although they definitely can't hurt. But again, they don't impact any trading decision. Fundamentals don't impact any trading decisions for me.
So then let's ask a technical question. We've just had the sharpest January up in something like 20 years. Is that affecting your decision as a technical trader?
Oh yeah, 100%, 100%. While it seemingly is a ridiculous strategy to buy into weakness and sell into strength, that's always what I've done. And while I do believe that we probably have more to go, there are some opportunities to get some negative directional bias without having to be 100% correct. So you don't need to sell stock right now because you think it's going down. You can figure out how you can maybe sell some call spreads to start getting into some sort of position. Because while there is every reason out there to be bullish, we at the same time are at a nauseating level of overbought, like nauseating, one that I haven't seen in probably my whole entire trading career.
So posting another winning month on top of January to you would be a lot like hitting an out of the park home run at Yankee Stadium, isn't it?
Well, if we have an up 7% in February, which is followed by an up 7% in January, again, that's possible. It is possible.
Let's say if we get an up 7% February, I'm calling it a year.
Well, if we guess, then we're all going on vacation together. We're all going to Vegas for the rest of the year.
Yeah, I tell people to take a round the world cruise at that point.
We're going to have a great time. But yeah, I mean, this is, again, like markets can be irrational. You know, typically this is not always a trader's market because we like two-sided action. We like bulls making money and bears making money. But this is one-of-a-kind move. Again, I've been doing this every day for a little over 10 years, and I've never seen something so just parabolic, just almost straight up. But this is a nice opportunity to maybe trim some longs or start seeing how you could reduce your cost basis on your long positions.
Yeah, actually, you brought up a very interesting point, two-sided trade. We haven't had two-sided trade this year.
No,
and for a hedge fund, that means you've lost 50% of your trades.
Oh, hedge funds are
put on a short
underperforming
in these kind of conditions. You know, we have our own market timing indexes, which are all algorithm driven, and it's been saying sell for 3 months. You know, and at a certain point, you just have to take your technical stuff and throw it out the window and say, look, there's something unprecedented going on here. You don't short on pain of death in this kind of market.
Correct. Yeah, I mean, a lot of people have done really well for a number of years, since 2009. If you close your eyes at some point in 2009 and bought, and you woke up all of a sudden 8, 9, 10 years later, you would be sitting on a big pile of money, and that'd be fantastic. But yeah, this can go way up for way longer than we think. But if you have a long position, you've done really well, it's not the worst idea to start paring back or reducing your cost basis a little bit.
Yeah, and another thing I ask my own readers, how smart are you really? You know, if you've just outperformed the market in a major way, you beat every hedge fund, you beat every 50-year veteran in the mutual fund world, do you really expect that to continue? You know, are you really that smart? You know, I think the answer for most people is no. Michael, what's your view on this issue?
Pretty much in line with what others are saying. I don't use fundamentals in my analysis, but I do look at them. And so I believe that the act is in the market. I think that it's going to get deeper into the market once everyone realizes what will or will not be done with this newfound cash that everyone thinks is going to come back to the United States. Like the balance, I think that there are a lot of trades that can be done in both directions during this period of while we wait for that ultimate top to be registered. And the only thing that really would upset that apple cart is if we dry up on one side or the other. If I shouldn't say, if the sell side dries up and it just forces things higher and higher and higher and higher because the sellers have said, I've done enough and I'm done. And unless we start to see, retail coming in to take their own profit, I don't know. But I do believe that there are something beginning to crack. Is that the works, and so I think that if you're really you can go.
Okay, I think Michael, I think you're freezing up a bit there.
Go ahead. Freezing up?
No, you aren't now. Keep talking. The audio's coming through, but the video's freezing a bit.
Okay. Yeah. Sorry. I live at the top of the hill in San Francisco, and that's what
I have the same problem.
Side of the water.
I'm on the other mountain.
Yeah. In any case, I think that you have to be more, I don't want to say inventive, you just have to be more curious and being able to go and look outside of what you might consider your normal. I think there's a ton of opportunity in commodities, a ton of opportunity in precious metals, opportunity in interest rates. So I think that the focus turns into stocks because that's where everybody throws their money. But I think that there's really opportunity in other places.
I couldn't agree more. And I'll tell you what our current positions are. We have a double short in the Treasury bond market. We have a double long in gold, and we're long Freeport-McMoRan, which is a copper play. So we really don't have any traditional U.S. earnings plays. Those have become the most overbought. I mean, look at Boeing. Boeing accounted for 40% of the move up in the Dow average in January, which is crazy. Love the company, great business. They've just gotten really, really expensive. And what I call our whole strategy right now is based on the exploding deficits trade. The fact that the U.S. budget deficit is in the process of doubling this year, and that the national debt is in the process of moving from $20 trillion to $30 trillion over the next 10 years. That has unleashed a whole bunch of new trades, which are really only a few weeks old. And I'm talking about the old inflation trades, short bonds, long gold, silver, long commodities, and short the dollar. So you buy the yen, the euro, the Aussie, and the loonie. That is a whole new universe of trades, which are brand new. I mean, you look at these charts, look at 10, 20-year charts. We are only at the very early stages. So, if you've been at the game a long time, and I've been doing it for a couple of years, you want to move out of the late stage trades, i.e. equities, U.S. stocks, technology stocks, and so on, and move into the early stage trades, which are the ones I just described, long gold, short bonds, long commodities, long inflation. That is where the low-hanging fruit is right now. That is where the easy money will be made. Yes, you may get an extra $20 or $30 on NVIDIA, but you could get a double in gold from here. You could get a double on a bond short. You could get a double in Freeport-McMoRan. In fact, they have to double just to get up to their old highs. So that's how you deal with an expensive market. You find cheap stuff. What do you do at a 9-year market high? You look for cheap stuff. What's cheap? Commodities, gold, silver, you name it. So that is the way to play this market.
I am going to agree with you on that one, John, but I'm just going to add one thing. The last show that we did together, I believe, was the Analyze Your Trade. And I'm gonna blame that rise in Boeing on you because you cleanly said it was going above 300 at that time.
Yeah, well, I'll take responsibility for a lot of trades. By the way, if Boeing saved your life anytime in the past, you love that company, and I know a lot of people who owe their lives to the reliability of Boeing airplanes, whose planes seem to be made out of steel girders. If you've ever had to crash one, and I've had to do that a couple of times. One other thing I wanted to mention that you brought out, one-way trade, We're seeing that in the stock market. You know what other market is seeing one-way trade right now? Real estate. You know, look at the real estate section in the San Francisco Chronicle right now. It's like 5 pages thick. It used to be 100 pages. There is no inventory. People have pulled their houses off the market because they're afraid if they sell it, they won't be able to get into another one, or they'll have to pay a much higher price. You're seeing exactly the same behavior in the stock market right now. You know, another melt-up situation. So since we have a bunch of technical traders here, let me ask a technical question, and I'll go back to Simon Klein of TradeSmartForex.com. What are the 1 or 2 technical indicators you follow which you believe are most valuable in predicting the market on a short-term basis?
Great question. I don't really use indicators, price action, candlestick charts, and everything you need to know is in those charts. The one indicator I do use now and again is CCI, Commodity Channel Index. And I use that to help time entries in choppy sideways markets, help play bases and breakouts and that sort of thing. But you can see everything you need if you know how to spot supply and demand in the market. That's where the market's going to move between. And in upward moving markets, supply is going to push price down and then it's going to pick up and go higher. Sideways moving market is going to oscillate between supply and demand zones. And in downward trending markets, it's going to push up to supply and then come and break through demand and go lower. That's how the markets work. So if you can identify areas of supply and demand in the market, then you know where most trends are going to begin and end. So the 3 most important things that you need to know in the market are, from the technical perspective, are what trend are you in? Are you in a trend? Is it going up or down? Yeah. Where are my levels of supply and demand? And what direction is price currently moving in? For example, you can be in an uptrend and price can be going down, yeah, because it's going through a pullback. So that might not be, unless you're a market maker, building a position on the pullback, which is what you might want to do. But that, for most traders, is you want to wait until the market stops going down and turns to the upside again, usually an area of demand. So when the price changes direction to up in an area of demand in an uptrend, that's a great place to get into a trade and manage your risk.
Okay, well, that is a very intelligent, well thought out answer. Tell me, the Commodity Channel Index, is that available on any of the mainstream data sources like Bloomberg, or can we find it on the internet or something like that?
Well, let me share my screen with you. I can show you. Let me show you a few things on this. Another one that's actually a very, you're mentioning great trades at the moment, one that's going up and it's been going up for the past 5 or 6 months already is oil. That's another one that could go back to the 100 mark again. Let me see if I can share my screen with you. Let me know if you can see it. You see my screen?
Yes, but it's your other screen.
Yeah, I see it on a thumbnail. David, can you make that chart? Bring that chart up to
I'm not speaking from
the
here.
main screen.
It should be on the main screen now. Is everyone seeing it?
Everyone see this?
We see yours, David. We don't see Simon's.
I'll tell you what. Let me close it down. I'll go on my laptop. I was thinking it's much easier for me on this, but let me. Okay. Experiment time. Okay, let me see.
I don't need the chart because I have the oil chart in my head.
I also see the charts in my. I also see the charts. I know where everything is in every market that I follow, which is a very good idea. Let me see if I can share it from this on my laptop now completely. So let's see.
But yeah, we definitely have had a major breakout in oil to the upside. Okay, now I can see something.
See this now? I can push this down, and can you see everything clearly here?
Yep. Yeah, these are all the CL charts on multiple time frames.
Yeah.
There it is. There it is.
Yeah, so I'm on my laptop at the moment now. Okay, so if we look at this chart here, the monthly chart, you can see we've got, this is a commodity channel index at the bottom. You can do it. This is a Thinkorswim platform. Again, you can get it on most charting platforms.
Yeah, they all have this sort of stuff now.
Yeah, and the basics of how to use it are it measures overbought and oversold. But again, you have to use it in the right way. If you're in an upward moving market, for example, then, you know, this has been overbought for quite a long time. That doesn't mean sell. Yeah. But if I blow this chart up, and you can see here's a prime example of an entry that we talked about in our trading room, which was around the summer months of last year, when you want to be kind of getting long oil. Right around here, when it comes down to this is demand zone, direction changes to the upside, and you're starting to trend to the upside. And look, and we've broken above this area. Okay, this is most likely that we're going to break. And you can see we've gone above, and we've got a clear run all the way back up to the 100 mark. There's nothing much there to stop you going.
By the way, that is also exactly the chart for gold and for U.S. 10-year Treasury.
Yeah.
They're,
let me
all breaking out of a four-year resistance point at the same time, which is very interesting.
You can see gold as well. Let me just make this bigger here. It's not. 1 second. Let's maximize. This is gold. Yeah.
Yep.
Monthly chart again came back into demand, turned around, and again we've got pretty much it. If it breaks above this area and that all these previous highs, we've got to run up to this area as the next stopping point around the 1600 area. So again, these start, as you said before, these are the ones that are just starting.
Yeah, right. And a 10-year Treasury yield is the exact same chart. What do all three of these charts have in common? Inflation. These are all inflation plays.
And let's see what else we can pull up. That's interesting.
So if we're about to enter inflation plays, don't sell your house. Keep it off the market like everyone else. It's about to double in value.
Here's another interesting one that I mentioned many times on previous shows. This is the Australian dollar. Again, it's a commodity-based currency.
Right.
It's commodity-based currency. So again, this one's just starting. We talked about it a number of months ago to buy down here. You can go back to the timing research show from a number of months ago when the market was down here, and I said, this is a good place to get in for a long-term trade up to probably this area and potentially up here. And again, it's starting out. It's in play at the moment. And we picked up the trade actually here and played this up, and we picked it up here and we're playing this.
Yeah, I've been telling my Australian followers, don't pay for your European vacation yet. It's about to get a lot cheaper. Okay, I'll go on with Stephen Brooks of TimingResearch.com. What are your 1 or 2 favorite indicators that are best at predicting the short-term direction of the market?
So I'm a little bit similar to Simon, where I don't necessarily have an indicator. What I have on my screen are really 2 things. The first is about price action. And what I do is I check and see what a stock or commodity or future has done in the last 10 trading days. And what I've noticed based off of a lot of data from the CME, that if a stock is down greater than 5% in a 10-day period, minus like the volatility ones, it's more likely to go higher than it is to continue lower. So in terms of getting into a short-term entry, that's something I look at. But then the other one that I have on my charts is just based off of where implied volatility is compared to itself over the last year. And obviously, if you're an options trader, when that volatility indicator is on the high end of the range, there are some nice opportunities maybe to sell some premium. And then on the low end of the range, it doesn't necessarily mean you buy some premium, but it's a good opportunity to maybe get in from a different side of the market. So not a lot of indicators, but those are the 2 that I most likely look at.
Okay, and Michael of LogicalSignals.com, 1 or 2 favorite indicators.
Primary are I use Elliott wave, and then of course associated with that I use Fibonacci. And as other indicators,
okay, I think we got another mountaintop freeze here until he comes back. Michael, you with us again?
yes. How much did you get? None of it?
The last 4 words.
I'm sorry.
Say it again.
I use Elliott wave, Fibonacci, stochastic momentum, ATR. Those are my primary indicator tools.
Elliott Wave's kind of missed the boat here for the last couple of years, hasn't it? It's been pretty
Actually,
negative.
it has not. It's whoever is using it is not doing it correctly.
Okay.
It actually hasn't missed the boat, in my estimation. I think that the big misnomer about Elliott Wave is it gets into people's hands and they want to change the original postulates to reflect more what they think. And then it's not Elliott Wave anymore, is it? So I take it. I don't like people changing what's already been set up for them, because then it's not giving an accurate reading of the market. And where Elliott Wave shines is when you're in this, what we might consider no man's land, when a market starts to move into uncharted territory, in our case, higher, you can use Fibonacci along with Elliott Wave, and you can estimate where these things are going to go. And as it continues to break on the upside, you can expand. And it's not like you're wrong. It's just going to give you what the probabilities are.
So let me ask an Elliott Wave question. Are we in the fifth wave?
In the Dow Jones, we are in the fifth of the fifth of the fifth.
Wow, that sounds scary.
Yeah, it can be, but it has now extended. I originally had numbers around 25,000. Didn't think it would get much above there, but now it's another 1,000 points up. And so now it really pushes maybe a max upward between, I think, 27.5 and 28,000.
Yeah,
I'd have to go look.
Our in-house target for the Dow is 30,000 by May next year.
By May next year, okay.
We have that's our 18-month target, which is now a 14-month target. Okay, well, we're getting into the tag ends of things here. Why don't we go through our three guests and spend 60 seconds talking about who you are, how do we find you, and what you will do for us. And when I say 60 seconds, when I say a minute, I mean the 60-second variety of minutes. Okay, we'll start with Simon of TradeSmartForex.com.
Okay, hi, can you hear me?
Yep, we can.
Okay, I just moved completely to my laptop now, so
okay.
I thought if that's not working, be here. Websites, TradeSmartForex.com. You can go there. They can check out some free videos. Have a YouTube channel. We put out a video once a week on where the dollar's going next. It's been pretty accurate pretty much all of the past year. Our predictions of where the dollar is likely to go next. Again, we give the options and the probabilities, and we say, if this happens in the market, then this is likely to happen next. And if something else happens, then another thing's likely to happen. So we give the options, and then you can see it play out in real time in the market. And again, it's done ahead of time, not afterwards. And, we have to make decisions on the right edge of the chart, not after it's actually happened and look back and say, oh, buy there and sell there. So you can go to my website, and we have a webinar that we're doing soon, because we're getting involved a little bit in the crypto world, blockchain, cryptocurrencies. So we have a webinar coming up at the beginning of February, and we're going to do an introduction to Bitcoin for those of you who want to learn a little bit about blockchain technologies and Bitcoin and cryptocurrencies. So feel free to go to the website, sign up for that, sign up to the YouTube channel, and have a look around. There's lots of free videos out. So thank you very much for having me on the show again.
Okay, Stephen Brooks of StephenBrooks.com. Tell us where we can find you and where we can get some good batting tips also.
I'll try to find some old YouTube clips of myself. You can find me at StephenBrooks.co. I do a weekly live training in the evening every Thursday, where I teach some very simple setups. Most of my audience are people that have no investing experience, which I kind of love. I kind of love taking people when they're really, really green and teaching them some simple things that they can look at and understand every single day. So if you go over to StephenBrooks.co, you'll be able to find that out. Again, it's every week live on Thursday nights. What I did last time I was on the show was I offered a free one-on-one session for anyone who's watching. The way you can do that is go to stephenbrooks.co/one-on-one. We had a handful of people sign up. Nothing to it, just if you want to keep talking about markets, if you were interested in anything that I said. I love talking about this stuff. I'm happy to jump on a 30-minute call for anyone who is on this live. That's stephenbrooks.co/one-on-one. And thanks again for having me. This is a blast.
Okay, Michael Filiguera of logicalsignals.com.
You can reach me at michael@logicalsignals.com or michael@mjf1partners.com. And you can drop me an email. I respond always. The website's not ready yet, so what you're going to see is old. And again, I'm going to be switching that around. I'm going to be doing, instead of a trade room where we're actually getting as many people as we can to come in and trade, I find it's going to be much easier for me just to do one-on-one sessions with people in more of a coaching manner. And that's for my trade room. And then I will be providing daily commentary on the markets via the website.
All right, and taking up the tail end here, this is John Thomas from the Diary of a Mad Hedge Fund Trader. David, if you can put my slides up. We offer a daily research service, long and short ideas, all asset classes. We also publish the Mad Hedge Technology Letter, which is a real insider's view of what's going on in technology and where the great trading opportunities are there. That's the Mad Hedge Technology Letter, and we're having a introductory webinar on that this coming Wednesday at noon Eastern. David, I think the slide's down in the thumbnail. If you can pop it up to the main screen so people can see it.
Yeah, the viewers can see it as, on the main screen now.
That's our trailing one-year return, up 56.62%. We run this like a classic hedge fund, you know, basically making money in all market conditions, in all circumstances. You can see how we really caught this latest melt up all the way back in last August. Some of the stocks have doubled since then, and we are now rotating into other asset classes to deal with this extreme overbought condition in equities. You can find us at madhedgefundtrader.com, and you can sign up there to receive free research and free trade alerts. So that's it, pretty much it for today. At this end, David, if you have any other closing comments, please feel free to jump in.
Thanks, guys. Great show. We originally had Matt Buckley scheduled to moderate today, but he had to take care of something else. So John Thomas very nicely offered to moderate for today. So really appreciate that. Also, for those of you watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. And be sure to join us tomorrow, January 30th, at 9 p.m. Eastern Time for the 21st episode of Analyze Your Trade. Oliver Schmalholz, Roy Swanson, and Dean Jenkins will be on for that one. So you can always get the link to the live show by going to TimingResearch.com/live. And just want to thank all my guests again for today. Simon Klein of TradesmartForex.com, Stephen Brooks of StephenBrooks.co, Michael Filiguera of LogicalSignals.com, and John Thomas of MadHedgeFundTrader.com. Thanks, guys.
Thank you.
Thank you.